Is this 2008 all over again for the real estate markets? That's what we're going to talk about real quick today. And I want to first jump in and just say I hope this finds everybody healthy and safe. I hope everyone is doing well. Everyone's managing the new normal that we have right now, and I hope everyone's families are safe and healthy. So to start off with that, just want to lead it in with that. But now what we're going to talk about today is what does this look like, right? What is going on right now in the real estate markets? What does this look like compared to 2008, compared to some like previous recessions? And what does that mean, right? What are we looking for? And of course, no one has a crystal ball. No one can tell you exactly what's going to happen. But we do have two things. We have history and we have statistics. And we can look at both of those and have an idea of maybe what could come from what we're seeing today, right? Obviously, here in New York, New Jersey area, the metropolitan area, things are slow. Things have slowed down. We haven't seen much activity. We've seen some buyers and sellers and renters and landlords still who really need to move. They are transacting, they're signing new leases, they're making offers, but it's much lower volume. And we expect it to be like that for the next few weeks, few months, but we do expect things to probably get back to normal. So the short answer is this 2008 all over again? It does not seem so. It seems like this is going to be a different recession, different slowdown, different recovery than we saw in the past. And I have a few slides which I'm going to pull up, which we'll talk through a little bit with some numbers and statistics kind of giving us an idea of why that might be, right? And again, look, I'm not a professional economist. I run a local real estate team. I stay on top of the markets as much as possible. I try to understand what's going on in Hoboken, Hudson County, New Jersey, New York City metropolitan, and kind of out and out and out. And of course, the world economy and the U.S. economy plays into that. So we'll talk about some of those different things. But the first thing I think that's very important to realize is that a recession does not always equal a housing crisis. I think we're all very familiar with what happened in 2008. And we think, recession, slowdown, economy slow down, people lose jobs, housing market suffers automatically. And there's a lot of history and data out there that doesn't exactly support that. So we'll take a look real quick here at a couple slides and a couple things just to get started. And we'll look at the last 4 or 5, or just 1, 2, 3, 4, 5 major slowdowns and recessions that we saw here in the US. And we see 2008, 2001, 1991, 1981, and 1980. And we saw that real estate was only affected in really 2 out of those last 5 slowdowns and recessions. So let's just realize on a big level that, yes, some recessions definitely do cause a real estate slowdown and prices to decrease, but not always. There are some scenarios where that doesn't happen. And just kind of puts things in perspective that it is a case-by-case situation. We can't automatically correlate those 2 things together, right? Taking a little deeper dive into what happened in 2008, right? We saw the S&P 500 go down almost 50%, more than 50%. What we saw in the housing market was about a 20% depreciation. So another thing, just kind of diverging the lockstep of one market goes down, the other market goes down. They are not directly correlated. They move in, tandem sometimes, but they also many times are a little bit fragmented. And as soon as one thing happens, the other thing doesn't happen the exact same amount. So 2008 was definitely an interesting time. We had a housing market which wasn't healthy. The housing market, for the most part, was the cause of the 2008 recession. So when things started kind of unraveling and piece by piece not performing the way they should, housing was the driver of that. They were the cause for that. So in this scenario, which we'll get into in one more slide, we have the housing market and the real estate market being an effect of something else causing this economic slowdown and a coming recession. So this is just breaking things down a little bit, showing what happened in 2008. Definitely a recession caused by the housing market. So this is a big slide to look at. In 2008, you would not have seen this much equity in homes. And this is important for a major reason in housing. You can absorb a little bit of price fluctuation if the majority of the country has a lot of equity in their homes. 53.8% have at least 50% equity in their homes. That's huge. That means if the prices come down 5, 10, 15% for a year or two, and we do see a little bit of a fluctuation here, people aren't going to be short selling. People aren't going to be fire selling. They're going to be able to ride out that cycle, which as soon as you start seeing short sales and foreclosures and things like that, that creates a self-fulfilling prophecy where things really start spiraling and kind of catering in on itself. So the fact that a lot of people have a ton of equity in their home is definitely a good sign to show that this market right now is not like what we saw in 2008 for the real estate side of things, people can absorb some, downward pressure for a couple of years if that's what happens. Another big thing to look at from 2007, 2008 to what we have today is something called inventory. And if you're not familiar with inventory, the way it's used in the real estate market, it's essentially how many months would it take to sell off everything that we have on the market today based on how quickly we're selling them if nothing new came on, right? So back in 2007, if no new listings came on the market, it would take about 8.2 months to sell off everything that's existing at the rate that buyers are buying. Today, it was about 3.1% of inventory. This is on a national scale. Hoboken was even tighter than that. Hudson County was even tighter than 3 months of inventory. We were about 2.5 months. It would take 3 months only to sell off everything we already had on. So the fact is the buyer's demand versus the seller's supply, the buyer demand was much stronger and much healthier than supply that we had. So it's just another kind of way to look at what happened as we rolled into this economic slowdown and housing market, real estate slowdown. And market prior, where was the real estate market prior to things changing? All right, so here is another good slide just to look at the health, right? The health of the real estate market. We looked at how much equity, we looked at how much supply. Here's how many people did an equity cash out refi of their home before these two crises hit. And what this means is you have that 50, 60% equity in your home, and you decided to call your mortgage banker and say, hey, I'd like to get some of that cash out into my pocket, and I'll just take on a bigger loan, therefore reducing your equity, but pulling actual cash out. And people were doing this in 2007 and 8 because they thought prices would go up forever. They had money in their equity of their home. They wanted to put a pool in. They wanted to buy a big screen TV. They wanted to go on a vacation. So people were doing this quite dramatically. We saw in those 3 years leading up to 2008 housing crisis, we saw $824 billion of cash out refis. Now, in the last 3 years leading up to our current pandemic crisis situation that we're in, we saw, a quarter of that, $232 billion that was pulled out of equity. So less was pulled out, more stayed in the housing market. That's a strong housing market. That's a housing market that can sustain a little bit of slowdowns, a little bit of a cycle of economic pressure. So long story short is more responsible home ownership and home purchasing has happened in the past 3 years leading up to this. Another just good sign, not to say things aren't going to slow down, not to say things, we might not see a little price dip for a year, 2 years, maybe longer. This is all just what we're able to tell from history and what the numbers are actually telling us. All right. Another thing that shows kind of a calmer market, as we led into this slowdown, we saw appreciation in 2000 through 2005 through the roof, 10, 8, 12% a year. And this is why people were pulling all their equity out. They said, it's going to keep going up forever. I'll take this money, go do something with it because it goes up 10, 15, 20% a year. This is great. We saw a very healthy real estate market from 2014, 2019, but a more reasonable one that was driven by actual economic improvement, actually driven by people making more money and being able to afford their homes. So it was a calmer, more progressive move of appreciation rather than a very almost fake appreciation that was just ridiculously overblown by just over demand and, really, quite frankly, irresponsible lending. Taking one more look, or I think we have one or two more slides here on this kind of topic. We're looking at the availability of mortgage lending during the two lead ups to the recessions. In 2007, 8, 9, leading up to 2008, everybody can get a mortgage. Everybody was able to get one. The index was super high. As you can see, that dropped off a cliff because we realized that was irresponsible. And slowly now, people being able to get mortgages, getting a little bit looser, getting a little tighter, but being way more responsible. Moral of the story is people that should be getting mortgages, that can afford the home they're buying, they're the ones getting the mortgages right now. And for the past 5, 10 years leading up to this. Back in 2007, 6, 7, and 8, everybody and anybody, no income verification, everyone was getting a mortgage. So that was very responsible. The housing market was in tough shape. Any little downturn was going to wipe out a whole bunch of people, which it did. Today, we don't see that as being the case. We're seeing a much stronger, more qualified person who has been buying real estate for the last 5 or 10 years. And this is taking another look at that same point. Back in 2006, people were using about 25% of their household income towards their mortgage payment, towards their housing expenses. Today, we see that under 15%. Again, a little bit more way more responsible, more comfortable. People who are qualified are the ones who are owning the houses who will be able to maintain keeping their homes and not need to fire sale and go into foreclosure and things that really spiral a real estate market downwards. So the other thing that we have to look at here is, so one point is that real estate is not always tied to a recession, right? Real estate going down is not always tied to a stock market going down in a recession. Two, the health of the real estate market leading into a recession has a lot to do with that, which is what we were just looking at. And three is, what type of slowdown or recession are we seeing? Are we seeing one that's going to be like in 2008, they called it an L shape, right? It was almost a straight drop down, and then it flatlined for 3, 2, 3, 4 years. That is not what's expected right now, because what we're dealing with is a very acute problem. You know, it could last 6 months, 12 months, 18 months before we fully get back to a normal society. Hopefully shorter, but who knows? We don't have clarity on that right now. But all the major three up here, as of April 1st, we're calling for what's called a V-shaped recovery. A V-shape is, very steep down, and then a very quick, when things get better, bounce back up. And because of pent-up demand, you'll see a lot of these projections by Goldman, JP Morgan, and Morgan Stanley. You'll see them show even growth beyond where we were because of how much pent-up demand and real desire there's going to be to get back out into the world and the marketplace. Like we might not see baseball season, we might see some restaurants slowly open up, but eventually, through time, as we get back to normal, get this under control, there should be pent-up demand, people wanting to get back out into the world and spend money that they've hopefully been saving and being more conservative with now. And one more thing that we have to support that same kind of thought process of likely having a short cycle here, a short downward cycle, is we look back to the Great Depression, Great Recession, and then what we're currently in today. And we look at unemployment, right? Obviously, unemployment is one of the biggest drivers of any economic cycle. People don't have jobs, they don't spend money, and it just spirals, right? It becomes a self-fulfilling prophecy, essentially. We look at the Great Depression, we had a slow start, but then spiked to over 20, 21%, 25% unemployment, and it stayed there for a prolonged period of time, 5, 6 years. Great Recession, not as dramatic. We went from 7, 9, 9, 8, 7, but stayed pretty, helped like a reasonable amount of unemployment for a good amount of time. 2020, because this is so unique, this is something so different than those other two recessions, it spiked, right? And this is a couple days old after the most recent numbers that came out. I think we're over 22% even unemployment. But what Goldman Sachs believes, and what a lot of people talking about how the market cycle here, is that we're likely going to see, once things get back to normal, a lot of those people go right back to work, right? Right now, I know like a lot of kids are home, right? School teachers are still working, but daycares and nannies and things like that aren't working. Doctors' offices are closed for non-essential things, right? Dentists are closing down. All those hygienists and staff and all those people, those jobs will still be there in 6 months, 3 months, 2 months, a year, whatever the time frame is. So the projection and the thinking right now is a lot of those people go right back to work. The restaurants, the bars, it might be a different scene for the next couple of years, but we are going to likely see people get back to work quickly once things kind of get stabilized, normalized here. So again, guys, this is all projections. This is all just ideas of what we likely will see, what history tells us that we can expect and what we've seen before, and what numbers, actually current numbers, are looking like today. Anything can happen. It's a day by day, hour by hour at some points, change in the marketplace. So we're keeping up on it. We're going to do on Monday, I'm going to look back and take a look at what happened in the real estate market, this first third of April or 2/3 of April. Compare that against what we saw in March, take a real look at what's going on activity-wise. But I could tell you just from, without looking at the numbers yet, we're seeing activity just much lower volume. And the problem with why that is, obviously we can't go out, we can't do things, but there's so much uncertainty right now. As certainty starts to come back into the marketplace, even if we're certain that things are going to be, slow and kind of weird for 6 more months, another year, we'll know that, and we can decide then as a marketplace who wants to transact, who wants to wait, who needs to move, who doesn't, and start to get some clarity on that moving forward. Uncertainty and not having clarity is always one of the main things that we see stop the markets, right? People don't know what to do. Stop. Don't do anything. Make no decisions. Let's wait to see what happens. That's what we've been dealing with the last 30 days or so. And we'll probably deal with that in different varying degrees over the next 6 months or a year. But keeping current on what's going on and keeping an eye on the market is what we do. So I'll be making videos like this, sharing it out. Hope this is helpful. If you guys have any questions about how this may affect you personally what's going on in your particular market, what's going on, anything a little more granular than this kind of overarching bigger view, feel free to reach out. Always happy to have a conversation. That's what we're here for. So guys, stay safe, stay healthy, enjoy some time, extra time with your family, and I will talk to all of you soon. Bye.